So, whoo-wee, look at this. Right off the bat, we got a rare, massive thing for the stock market that has something to do with the government, okay? So, there's this development here on basically the Trump administration. Trump specifically is trying to push through this thing, which is money accounts for growth and advancement, or MAGA accounts, they call them, okay? Which would seed index fund accounts with $1,000 in government funds for U.S. citizens born between January 1st, 2025 and December 31st, 2028. Now, if this program does start, my guess is it will probably be continued for future presidents as well, whether they're Republican or Democrat. But that's if this gets through, right? The tax-deferred accounts, which track the overall U.S. stock market, allow additional contributions of up to $5,000 per year. The seed money will be funded by the Treasury Department and controlled by the child's guardians, a la parents. Funds can be distributed once the beneficiary turns 18 years old. Now, a couple things here before we get in the good of this. One, this could get blocked. It could get blocked. This is not a guarantee to go through. It's looking decent, I would say, right now, but it might still get blocked. Second thing is, okay, the government gives the $1,000 to the kids, right, in this fund. There's also potential the parents never contribute anything to it. So do keep that in mind, okay? But here's a deal, okay? Michael Dell came out, and he said that if the government does this, essentially Dell will then match what the government does. So they would then put $1,000 in this fund for every of their employees that has a kid, essentially, okay? And so then you got $1,000 going into the stock market from the government. You got another $1,000 going in for a company like Dell, if this ends up going through, right? Which is pretty substantial. Also, Uber CEO Dara, is for this. Goldman Sachs, David Solomon was there as well today. He's very excited about it, right? Now, based upon this, $1,000 times 3.6 million children are born a year, roughly. It's about $3.6 billion a year of inflow to the stock market. Now, keep in mind, $3.6 billion in government terms is actually not a big number. It's not like this is some budget blowing, like, oh my gosh, like this, they're going to blow up the budget with this. Like, no, like $3.6 billion, sadly enough, for the government in this day and age is just a rounding error. To be honest, this would just be a rounding error, which is why I think it has a pretty decent probability of going through, right? But it would be $3.6 billion a year of inflow, right? That's basically kind of like locked away. It's basically locked away until the kid turns 18, right? Now, keep in mind, my guess is if this does go through and they execute it well, which keep in mind when the government's involved, it might not be executed well, but let's say it is executed well. I think there's a lot of parents, grandparents, and companies that will add a lot of money to the kids' funds here, right? Especially if they do it in a way that makes it very easy for them to add capital. We know grandparents love to give money when their grandchildren are born, right? And so it's very common. I know at least in my family, the grandparents usually always gave a savings bond to all the kids born. Keep in mind, I was born in the 80s. A lot of my cousins were all born in the 80s or the 90s. So savings bonds were like huge. And so every time, a new grandkid was born, some got like $1,000 of savings bonds. Some of the earlier kids, somebody like myself, I think I got either $100 or $250 in government savings bonds. So, and of course that was more money back in those days than it is today, right? But yeah, I can see a lot of companies adding to this, grandparents, parents, things like that. So it would be a lot more money to inflow into the stock market overall every single year, right? Because once again, these kids won't be able to touch this money till they're 18. Now, that also brings me to a bigger point here, that it's a fascination for people to kind of hope the S&P 500 trades at that 10 to 15 range PE ratios, right? And I just got to say, get used to seeing 20 plus PE ratios for years and years to go in the stock market. I'm showing you the past 30 years, the past 3 decades of where PE ratios have been. What do we see consistently the past 3 decades? We see PE ratios 20 plus, right? Now, with the stock market being easier than ever to invest into, attracting more capital than ever, including even likely government capital now at this point in time, right? At the end of the day, you just have to get used to the fact that PE ratios are going to be 20 plus. Outside of some insane crash in the short term, or if interest rates go to like 10, 20% or something like that, outside of those scenarios, like it's going to be very common over the coming decades to expect what you've been seeing, honestly, for the last several decades, which is PE ratios of 20 plus. And so you just got to get used to it, right? Now, additionally, US stocks remain the place to be. And here's why. And here's how most people look at these other alternatives. Because you got to think, do you put money in US stocks or do you put money in something else? Okay. Well, what do you have options to? Bitcoin. Some, a very select few love Bitcoin. They're happy to invest as much as they can in Bitcoin, right? Other people are like, I don't trust that at all. I wouldn't stick my enemy's money in Bitcoin, right? Other people are like, I trust it a little bit. I'll put a little bit of capital into Bitcoin, right? But the masses, no. Bitcoin's not their thing, right? Gold. The masses don't like gold. It's a sleepy asset. Look at its performance over the past, 15, 20 years. It's a sleepy asset. The last year has been really good in gold, or at least the last 6 to 12 months been really good in gold, but for the most part, gold's sleepy, right? Silver. You could invest in silver. People say, why would I invest in silver? I'll just buy gold, right? That's what a lot of the masses kind of say. International stocks. International stocks is just a fancy way of saying you want to underperform the stock market in the US. That's all it is, man. And so the masses kind of look at international stocks and like, okay, so I could buy a bunch of stocks I don't even, use or even know these companies, and I'm going to likely make less money. No, I'll stick to US stocks. Thank you very much, right? And then there's real estate. The problem with real estate is people stress about that, right? If you want to real estate invest, people are like, that sounds complicated. There's stress involved with that. Things going on with the property. They're like, that sounds like work. That sounds like work. And then people say, in a lot of cities, you can't even make any good money on real estate investing right now. I'm serious. Like if you look at many of the big cities, whatever you would pay for a mortgage payment on a property, you'd make no money right now. You might even lose money on a month-to-month basis. So real estate is just, people are like, no. So at the end of the day, the place to be remains United States stock market. And that's from a global perspective because of all those issues that other things have, right? Alrighty, next up here, Google McDougal. So huge weekend for Google. It was in the news everywhere because of what happened in LA, right? And essentially this kind of marked like the epicenter of what was going on in LA this weekend over the whole ICE crackdowns and all that stuff, right? And people are pushing back against that. Some people are really mad. Some people are happy at the ICE crackdowns. You got people on both sides. And so some people are happy. Some people are very upset, clearly, right? And so Waymos were being burned left and right. I mean, not left and right. There was a few Waymos burned. It's not like there was like 600 Waymos taken out. No, it was like a few, right? And so roughly the dollar amount that they said was affected was around $600,000 of cars was burned, right? Now, here's the thing. This was like at least $100 million in free marketing, in my opinion. Like you couldn't have spent enough money to generate this sort of publicity for Waymo. Waymo looks like the victim in the end, right? Because they had nothing to do with this. It was self-driving cars driving around. And meanwhile, they're the subject of conversation all weekend that these self-driving Waymos were all, several of them were burned this weekend, right? So they look like the victim, and it just got them massive publicity. So people that never even heard of Waymo were talking about Waymo this weekend. Like the amount of people that never heard of Waymo before are like now well aware that these Waymos exist and they have no drivers inside, and they're like, oh, that's interesting, and it happened in there. These vehicles are in LA. That's an interesting thing, right? So I would say this is a bare minimum of $100 million in free marketing. So $600,000 of cars was burned, the estimate is, which by the way, that might even be covered by insurance. It might not even come out of Google's pocket, which $600,000, that's probably what Google makes per second. I mean, it's like ridiculous. It's like crazy, right? It's nothing for Google. But 100 million, if not hundreds of millions of dollars of free marketing, I think that's worth it, right? Now, additionally, keep in mind, Google's in a state right now with Waymo where they're expanding to many cities across the United States and will be expanding to many cities across the United States. So any publicity they can get, especially when it's not bad publicity, because it's not their fault their cars got burnt, right? It's just people did that, right? To send a message about something that had nothing to do with Waymo, just to be quite frank. But the moral of the story is here, right, is, they need as much attention as they can get as they get scaled and as they get expanded across the United States over the coming years. And it's very important that they brand themselves as the player in self-driving vehicles. right? That they actually have them in the market right now. You can take rides in these now and not in years from now or something like that, right? Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Wilson on stocks, market headwinds in the Trump tax bill.
Remain very noisy and uncertain, and I think this has been the case for the whole year. Our view, as you know, has been a bit different. We came in thinking the first half would be tougher, and the rate of change on a lot of things like earnings revisions and some of the headline would be negative. And in fact, that what we think happens that all got priced in the week after Liberation Day, right? It was violent. It was a deleveraging, and so now, as we look at the data itself, it's all inflected higher, and so don't ignore everything, but ignoring the headlines is probably a good strategy, and just focus on the data has turned up for the most part. And I think, I don't know where the trade negotiations are going. Nobody does. Sure. But I think it's very unlikely we're going to go back to where we were, a month and a half ago. Like, we bottomed in terms of the pain of that initial, announcement and how bad those tariffs were. So unless it really re-escalates in a negative fashion, I don't think the trade issue is even going to be enough to kind of take the momentum out of this market right now.
You know what the bear view sounds like? They would say that maybe some of the data, some of the earnings we've seen have been flattered by pull forward, and we'll get the bill for that later this summer. Do you think we're priced for that kind of slowdown, that weakness we could see in the summer months?
That's probably right, and we had that view too. There was a pull forward in Q1. Q1 ended up being better than they feared because, the numbers came down a bunch. I think the second quarter, though, is expected now to be weaker. So that's going to be the key. I think the biggest risk for the market is going to probably be either rates, as we've talked about in the past, north of 4.5%, or we do go into earnings season. It's not as good as, people were hoping for, and we have maybe a 5 to 7% correction. But that's not what people kind of want. People want another 10 to 15% drawdown to get, better, to get more exposure. And I just don't think you're going to get that. I mean, I've seen this a million times. You want it, but you're just going to have a shorter trigger finger.
Well, you had seen retail largely buying the dip. That's who participated when you got those ruptures in April. If we're not going to get dips like that anymore, what is the willingness of institutions to continue to put money to work right now, especially they didn't even buy the past dips we saw?
Yeah, I think institutions have re-risked, but there's still more to go. The area that I think that you have to watch is the systematic strategies, the CTAs, that price momentum money. We saw almost $500 billion of deleveraging in that period of sort of early March through mid-April, and they've re-risked maybe 30-40% of that. So that's another bid that's sort of, it's not fundamentally driven. It's just price momentum. So that's going to be kind of the underlying bid. And then I think, most institutions have re-risked. But one thing I haven't talked about yet is people are still making the quality bet. And we agree with that, meaning this isn't the beginning of a new cycle. It's once again an extension of the existing cycle. And the Fed's probably going to be cutting at some point later this year, early next year. And that really behooves the large cap quality equities.
Does it behoove companies specifically who can also wait out some of the tariff uncertainty? Because this has been a big part of the narrative, right? No one's making decisions. CapEx is largely stalled unless you're tech. Is there an element where, even though we don't have tariffs resolved, that you get companies who just get on with it and start to put capital to work?
Yeah, they got to run a business. And that's another reason why large cap quality businesses can do this. They can mitigate some of these, risks, whether it's tariffs, whether it's, maybe the government cutting back on certain types of spending. And one of the things that is getting through this tax bill that I think is still underappreciated is the tax incentives for CapEx and R&D spending. We think that could add 3 to 5% to earnings growth or cash earnings for these large multinationals. That's a big tailwind in addition to the weaker dollar. So there's just a lot of tailwinds I see from an earnings standpoint. And this is almost a perfect environment to climb the wall of worry because the economic data, the political, geopolitical data is messy, it's noisy, it's scary sometimes. But as long as the revision factors for earnings are heading north, it's just hard for stocks to go down.
When you say CapEx, I just think of a handful of tech companies. Do you think it goes beyond just tech leadership?
Oh, absolutely. I think this is about capital goods. I think this is not just about AI CapEx. Also, one thing to just keep in mind, the IT CapEx that's been good the last several years has really been concentrated just in AI. Okay, the traditional kind of upgrades you see in the enterprise and in the household have not been happening because there was a giant pull forward, remember, in 2020 and 2021 for work from home. Fair. So if you actually look at the IT CapEx cycle from 22 to 24, it was kind of a soft recession. And that's another part of our thesis. We've been going through these rolling recessions. And look, to me, the big catalyst to keep in mind for a broadening out is going to be when the Fed starts to signal they're more dovish. I don't know when that's going to be, but my guess is sometime in the third quarter, they're going to start to signal that. And that's when you're going to get a more broadening out to the lower quality parts of the market.
Does the why matter? Do we need it because inflation is coming in? Or is it going to be because the labor market is cracking?
Well, I mean, look, last fall, it was both, right? I mean, the labor market was cracking last summer. As soon as they signaled they were ready to step in, the market went up anyway. So that's why, I mean, I actually think a recession, if we finally get the, broad recession labor cycle, I don't think the equity markets are going anywhere near the April lows because the Fed will be able to act quickly. And we're like Pavlovian, right? And if retail is buying when the Fed wasn't even cutting, if they are cutting, there's going to be a big bid there. So look, there's always risks in the market. There's always something to be worried about. There's always things to be bearish on, and there's things to be bullish on. And that's our job. And I think, this year we've navigated that pretty well, being in the right places. And I think we're going to continue to have to shift what we want to own, not so much how much you want to own.
So to push back against his points there, when we talk about the Fed going to their next cut cycle, there's two risks that come along with that everybody has to understand here, okay? One, when the Fed signals they're about to do another cut cycle, some people could look at that and they say, oh boy, we're going into recession. That's why they're cutting, right? Now, that could be true. That could be false. We don't know. But the moral of the story is there's definitely a lot of worries that happen when the Fed starts to cut like that. And people start saying, you know what? Like recession. And then people start saying, how big's a recession going to be, right? Because you don't know. Like a recession could last a few quarters. A recession could last a whole year. A recession could last 2 years. So you don't know how far, how deep. You don't know how high unemployment rate. You don't know any of that. It's just a scary time whenever you're going in because you're like, crap, we don't know. Like it's going on a roller coaster ride and you don't know where the bottom is. Second risk here that we already witnessed this again, what was that last year, is if the Fed starts cutting, you could, hopefully we don't see this, but you could see the 10-year spike again, right? And you could see bonds in general spike because they're worried about longer run inflation expectations. If that happens, that could be a scary moment for the stock market for sure. If all of a sudden that 10-year starts popping again and all the bonds in general, all the treasuries in general start popping. So, that's just something to kind of keep in mind in regards to the whole, it's not just only good outcomes if the Fed enters their next cut cycle here in the next few months. It, could be some scary that comes along with that.
Acknowledge the one thing that could be a headwind for equities is interest rates. You wrote about it over the weekend. What is it about 450 that's challenging to this equity market? Because based on the rally we've seen over the past few weeks, we don't see much of a challenge.
Well, it's stabilized at 450. So we've identified this level like almost 2 years ago, and it's been like a charm. I mean, as soon as you cross 450 on the upside, the correlation between stocks and rates goes negative, and vice versa. Now, I do think that we kind of went to 470 in the April period, and then they calmed down again. I think the market is getting comfortable that they have enough tools, because the Treasury Secretary has talked about that, to keep it 450 or below if they need to. And I think we talked about this last time I was here. 475 is like the worst place, because that's where markets get really nervous. 5%, I actually get bullish, because then I know that they're going to come in and intervene with either liquidity injections or they're going to use these other tools that the Treasury Secretary has talked about. So we're optimistic that could be managed. And in other words, that risk could be a risk for 5 or 7%, but ultimately that risk will get managed too.
Do you get clients asking you now about the debt auctions, asking the equity strategist about the debt auctions that take place in the week?
Well, I don't really ask the equity folks, but people do ask about it for sure. And once again, we have seen many auctions, soft auctions for the last 2 or 3 years. We've seen this occur, and then they get control of it again. I don't want to dismiss the risk from the back end of the market. That is still, to me, the risk. It's the risk not only for markets, it's a risk for the U.S. Like we have too much debt, and this is a focus. And if we don't, ultimately, if we don't, cut the budget over time, and maybe the market is now giving them a lead, like, okay, we'll give you 12 months. But if we don't get serious about, budget reconciliation and actually reducing the size of the budget over time, this is an issue that's going to stay with us.
Yeah, no, when it comes to the tax cuts and all of that, right, which hopefully that bill, is finished off rather soon, but it's important for everybody to understand when it comes to the tax cuts and all that, right, when does that really start to positively affect the consumer, positively start to affect the business cycle and all those things? The answer is it doesn't even start to until, let's call it 2026. But that's like the start. The real effects positively will be in 2027. Okay, in terms of when it really trickles down to the consumer, and then maybe people start getting big refunds and things like that because they paid in too much during 2026 because they were focused on past tax rates and those sorts of things. So you're going to get some positive effect in 26, but you're just getting much more positive effect in 2027, 2028, and however long those are in for. And so just keep that in mind. If you think like that's going to get passed and right away it's going to mean like great things for the economy, no. It's going to take time because you have to have a whole tax cycle to get into that. Okay, so just something to keep in mind there. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Alrighty, let's go ahead and react.
139,000 jobs created on non-farm payrolls for the month of May, a smidge higher than we were expecting. And in the rearview mirror, well, there are some revisions. We lose 95,000 over the last 2 months. All right, let's proceed now with the...
Hold your horses for just a moment. That's a big revision down. 95,000, revised down in the last, what they say there? I feel like I heard the TV all of a sudden. In the last 2 months, that's a big number. That's a big number.
Employment rate, which remains at 4.2%. If we look at the earnings from a month-over-month perspective, it comes in up 0.4. Much better than expected. We were looking for up 0.3. In the rearview mirror, at least up to this point, I don't see revisions, up 0.4. That would equal January of this year, which was the best read. To find a higher read, you're back in August of last year. Now, let's look at average hourly earnings on a year-over-year basis. Hotter than expected, 3.9. That's a couple of tenths better we're looking for. 1/10 higher than the 3.8 in the rearview mirror. That equals the first 2 months of the year, which were the highest. To find a higher number, you're going to Dec of last year when it was 4%. Average weekly hours worked, and we want to always pay close attention to this. 34.3 is wild. It's the rearview mirror. It's the windshield. It's what we arrived at this time around this month, and that means we have 3 34.3s in a row, which is building. It was 34.1 and 34.2 in Jan and Feb, respectively. Labor force participation rate, always a welcoming event. We want to bring more people in. It comes in at 62.4. This is a miss. This is the first real miss. That's a couple tenths light, both in the rearview mirror and against expectations. It equals the lightest read of the year, which was in February. To find a lower number, you're going all the way back to the last month of 2022. And finally, drum roll, please, we're going to look at what I call U6, the underemployment rate, because the actual employment rate I already gave you at 4.2 is considered the U3. So U6 comes in at 7.8. That means that we have back-to-back 7.8s. The lowest read was 7.5. That was January of this year. Interest rates are moving up. Listen, 139,000 isn't off the charts strong, but it's stronger than the market was looking for. And even though you can say that we're losing a bit of steam on job creation, what you can say is that you cannot say that it's happening quickly. And you cannot say it isn't accompanied by a mixed bag of other economic fundamentals. Some point to slower glide path, some point to better glide path. Interest rates on the week, and this is important, a 2-year closed at 390 last week, so we're basically up close to 6 basis points. A 10-year closed at 441 last week. It's basically up 2 basis points. Pre-opening equities, they like this number. Back to you.
Yeah, and obviously you can see a lot of stocks up here today very nicely. Shopify up 5+%, Palantir up 5+%, Fubo up, Google up around 3% here today. SoFi's up over 3%, Amazon, Amazing Zon's up 2+%, Cheesecake's over 57, Meta's getting close to 700 again. This was a perfect, honestly perfect jobs number. And let me explain why this was literally as good as it could be for the situation we're in right now. This jobs number came in a little better than expected. So that takes the whole fear around like, oh, we're going into recession off the table, right? Doesn't mean recession can't come 6 months from now, 12 months from now, 18 months from now, 24 months from now, 36 months from now. But if anybody's trying to bet that, oh, we're going into recession right now, it's not showing. So that takes it off the table. But it's also perfect from the perspective of it's not some super, super strong number that would make you say, oh, the Fed should keep rates where they're at. If you're the Fed, you could look at this and you can say, well, yeah, a little better than expected, but this isn't a super strong number, and we're staying way restrictive. You look at where CPI is at, look where Fed funds rate is at, you're way restrictive right now. And so it's creating a, we can call it an economy that is doing okay, but it's not like it's super strong right now. It's not like this is some, banger numbers and you got, 200,000, 300,000 plus jobs coming in like you would in super strong times, right?